How you doing, guys? So today I'm going to be showing you how I use math and statistics in order to build my quant trading interface. So that sounds a little complicated and a little wordy, I know, but basically all this is using a little bit more of a math and statistical edge in your trading in order to elevate your profitability and in order to more so understand what's happening in the markets. So a little bit of a backstory. I worked at a fund, and while I was at that fund, I kind of was able to develop a basis of a trading strategy, which is this right here. You can see that I have the relative strength, and I have some moving averages, and I have some support and resistance up here. Okay, so this is pretty simple stuff. We can see that this is a bit of a zone right here where price is coming in, and usually pivoting, reversing, and then up here is a zone that I have found to be the usual range. So as we can see, it's coming up there. So in order to piece together this strategy, we kind of got to understand, right? Like if you're a new trader, and you're looking to, understand how you can put together a strategy. Let's say you already know about your common indicators, right? You have your on-chart indicators, which are going to be your moving averages, your SARs, whatever the heck it may be, right? And then you have your oscillator, which is going to be not so much of an indicator of the price itself, but it's going to be on the bottom, and it's going to be some kind of mathematical formula of the price, right? We have to look into a little bit deeper on what an indicator is, right? How is it determined? So the relative strength is a formula that's able to basically detect the deviation of price, right? The volatility, if you will. So let's say you're ready to get started. You understand what candlesticks are. You understand what all this other stuff is. And you have your trading layout right here. What you're going to do, right, is this is what I personally like for my setup and my trading setup. And what we're going to do is we're going to take this on a fundamental level, right? And we're going to narrow it down on how I myself use more of a quant and statistical methodology in order to make this work. So what we're going to do, right, and just to start is we're going to make this 13 for the EMA. So the exponential moving average is going to be weighted exponentially. It's going to move a little bit more based off of price movement, and then the simple moving average is going to be the opposite of that. It's going to move less. So this one, we're going to make this a 21, and then we're going to make this red. Oops. So now we can see, we can start putting together, right, the averages. So there's two things that you should really pay attention to when you're looking at the averages, okay? The things that you should pay attention to are the direction of the moving average and the percentage away from the moving average. So for example, we can see if we take out our measuring tool, when we have this right here, the percentage of the moving average, when we get to be about this much of a deviation away, it usually tends to, right, revert back to the mean. The mean is the average. That's called a mean reversion. Okay, mean reversion strategy, simple. Now, another thing to keep in mind is the direction of the moving average. Okay, when we're pointing down, we're in an uptrend. Pointing up, we're in an uptrend. Or down, yeah, down, we're in a downtrend. Excuse me. Up, we're in an uptrend. Pretty simple. Now, this can get a little bit wonky if we have some consolidation in the markets. But another thing to keep in mind, right, is the trading time. Okay, so if we're trading during market hours, we might have these spikes of volatility. We're looking at a 15-minute time frame, right? And next we have the relative strength. Okay, so how do we use the relative strength in this? Obviously, 30 is going to be oversold. We make this right here. We can have it as 30 sold. Then we can put it as 70. Have it's considered to be overbought. Alrighty, so if we really want to be buying, right, when the relative strength comes below if that's our goal and we've identified the conditions where this is going to be in effect. So we have one right here, have one right here. And I mean, how do we identify these, right? I mean, we just missed out on a bunch of signals. I mean, yes, this one was good. Yes, this one was also good. This one was good as well. Like right here. It's not bad. But how can we take this to another level, right? I mean, yes, this is not bad in terms of strategy, but how can we make this better? Okay, because we're missing some buys in here. Maybe this one. What if I wanted to not have to do this in terms of waiting for a long time? So this, now we're going to get into basically like the quantitative part of it, right? How can we take this strategy right here and make it better? All right. I mean, this is like what the textbook tells us to do. But me as a trader, I've developed my own style of trading, my own art of trading. I'm fully self-taught, you know what I mean? So that's just how I was able to do it. And this is what I found to be best for me. So if I go ahead and look at two things right here. So I have quant farming signals. Now I have a lot more signals and I have a lot more stuff that I can use and a lot more stuff that I can play with, right? And I have these zones too. So what do these mean, right? What is this? Basically what I'm doing right here, right, is I got rid of these two EMAs. EMAs are done. I mean, you can keep them if you want to, but for the sake of this, I'm not going to. Put one EMA, okay, on a higher time frame. So this EMA is going to be for the 4-hour time frame, and I'm on the 15-minute. So if the 4-hour EMA is at an angle, okay, and it's pointing downward, we're going to be getting sell signals. Now if it's pointing upward, we're going to be getting buy signals, right? We have all these different buy signals, have all these sell signals, we have all these buy signals, okay? Now it's up to us to determine, when do we close out the profits, how good is the signal, and essentially that's it, right? So for example, right, like let's say it's peak market hours, peak volatility, we get a buy signal, CPI is coming out tomorrow. Hey, maybe it's going to be a good buy signal, maybe it's going to go way up, or hey, maybe we just got a good CPI is coming out really soon, we just got a buy signal. Okay, let's take this trade. CPI comes out positive, boom, and it rips. This is kind of what you have to piece together as a trader, right? This is just more so the fundamentals of, okay, this is the setup right here, right? Now, the setup might not be as good if it's low volatility, right? Like, for example, there is no volatility right here. This is all just chop. Now, it comes up a little bit, sure, but I mean, at the time that it's at, you can see in the bottom 1330. Well, there's just not that much volatility. Now, if we have right here, have a little bit more volatility, right here even, that's much better, okay? So how are we getting these buy signals? And we obviously have the angles of the moving average. That's giving us a little bit of a quantitative edge right there, because now we're taking the angles. Now, what if we were able to take the linear regression? Okay, what is a linear regression? It's basically the bounds that data is confined to, right? Let's go ahead and put it in there. Here we go. So now I'm giving you the secret sauce. Now, this isn't just going to be when it crosses below 30, I'm going to take my buy. When it crosses above 70, I'm going to take my sell. Now, I'm running a linear regression so that when the price of the stock deviates, right, and it gives me my signal, okay, when it crosses below outside of the linear regression, then I'm going to get my signal. And it's going to be the opposite for these sell signals right here, right? So when it comes outside of the bounds of the linear regression, basically what this is going to do is adapt my threshold for the buy and sell zones. This is going to give me that quantitative edge just by running that linear regression on my oscillator. Okay, so that is what I found to be like the secret sauce for not only getting enough signals, right, but also not having to consistently adjust. the signals. So now this is like a full quant interface, right? This is how I trade, and how I use math in order to, make this better, right? Like, how do I optimize? What's the best regression to run, right? What's, the most amount of bars that I should look back in order to take my data. This is what I found to be the best. That's just for me. And for the angle and the moving average, I had to do the same thing for that. That's how you kind of use stats, right? In order to look back and see, okay, these are when we're getting the trades. This is when they typically look the best. Let's go ahead and back test this, right? And over the years that I've been trading, I've back tested, I've forward tested, and I've found these to be, in my opinion, the optimal parameters. Now, for your type of trading, and if you're trading the US 30 like I trade, maybe it'll work for you. But hey, maybe you're trading something different. Maybe you're trading gold. Maybe you're trading oil, whatever. Yes, it's still going to work for this because this is machine learning in terms of we are now using math. We're now running regressions. Our buy signals are adapting to the price, right? It's the machine is, adapting to it. So yes, it will work, but it might take a little bit of adjusting. That's kind of for you as a trader to figure out what adjustments are needed to make your strategy work. Now, guys, trading is not just super easy. It's not just sunshine and rainbows in terms of, okay, let's put a VWAP on here. Every time it touches this line, we're gonna buy, and then when it touches this line, it's gonna sell. Not how it works, guys. Not that easy. Just make money. You know what I mean? Like, it doesn't matter what you do. You know what I mean? It's obviously gonna take some due diligence on your end. So whatever it is that you may be trading, you're gonna have to go in, use these signals, right? Map out your levels. Where do you think you're gonna take profit, right? Like, let's say, we can combine this stuff. I have my buy zone right here. Every time I get in the buy zone, I get good signals. Okay, so maybe, that's my strategy. Every time I map out a buy zone, I get a signal that can be an automated signal, right? For example, if I go in here, I make an alert on it. Simple as this. Add an alert, create. Now, every time I get one of these little dots, I'm going to get alerted. And if I see that I'm alerted in that signal, like in that zone, and I take that trade, well, I see that more times than not, I'm going to win on that trade. As long as I have my proper risk management. Let's say I have my risk management of if it breaks the moving average. Because if it breaks that moving average, then I'm probably going to enter a sell zone, or be about to enter the sell zone. So that's a little bit about my personal quant trading interface. If you're interested in this, check out my website, quantfarming.com. That's the reason why I named it quantfarming.com, is because I'm a quant trader. I like to use math in order to give me that statistical advantage when I trade. If that's something that you're interested in, reach out to me on LinkedIn. Check out my website. I'd be happy to share this with you, and help you get that secret sauce when it comes to trading. So if you like this video, leave a thumbs up, subscribe. I'll be posting more of these. That's it for this video.